so far, with the exception of Pete, who said good afternoon when he first logged on the presentation, everyone who's sending in a comment is a David. So we just talked to David C. Ben sent his question by email, so that doesn't count. David H. made some comments about adding that midpoint in and changing the column so we could see it better. And now we have David N., who asked a question I knew I was going to get today, but I didn't put the slides together because it's always best to do this on the fly and go through it. And I'm sure it's on a lot of everyone's mind who's been using Power Options, been looking at Power Options. And the question is from David N., how does the sell signal currently on Power Options inform how I trade? I had another customer email in at about 3:30 today before the webinar. And I knew this was going to come up, but that's okay. We've covered this a few times before. I'm going to show you where that is first, David, and then we're going to get into it because those are older discussions and you want to know how it affects you now. Let's go back to the Home tab very quickly. Let's go to free webinars. And I want to go to options concepts. And here's market reaction September 20th is a little bit different, but it does discuss that slightly. But if you scroll down here in the options concepts, market sentiment review and current status, February 5th, 2021. I might have replaced it, but there were other webinars here as well. In addition to that, there we go. Another view you can always take is if you go to our basic YouTube channel, of course, and I'm here in the video section, go to the search and just type in market sentiment. But don't worry, I'm going to review this question. I just wanted to show you where other content is and why do I feel that's important. This one was from April of 2021, a 9-minute review of the market sentiment tool from February 26th. 12 minutes on the market sentiment from 1 year ago, quick review. So there's some other ones here. And the reason why I wanted to, this one was the one I think I liked. It was a 20 minutes long market sentiment review and current status, February 5th, 2021. Look at the market sentiment tool, August 21st, 2020. This one's a pretty good one because it goes into a historical view of what happened on certain dates back in time with a more, one of these has more of a bullet pointed view that we're going to talk about right now, but there's some other ones, okay? Now, let's get to square one. David's direct question, because we're here and it's today, and we've had about 5 or 6 days of sell warnings in a row. How does this signal on Power Options inform how I trade? Let's take a look at this. What is the market sentiment tool? The market sentiment is sort of a signaling tool based on 13 broad market-based indicators. Just as we reviewed a few moments ago, how I talked about Ernie set up the weekly picks of the day and the monthly picks of the day using various testing iterations of stock criteria and option criteria, and how I developed and then started trading the bull puts when I found search criteria that would meet my goals. I want to talk about that a little bit later too. Ernie tested probably 40 or 50 different indicators, both live in the market and going back historically. So when a change occurred, and seeing which indicators gave a best either preemptive signal for buy or sell around or just prior to the market turning. And the result was these 13. Whew. This one, I wanted to focus, I don't want to focus on, but I want to show this one. This one scared me the other day. I had never seen this before, to be honest with you. The last value, this is the put call volume ratio. The total number of puts across the entire market divided by the total number of calls, it's at 0.39. A ratio of 1 means that there's an even number of volume on calls and puts. That's kind of scary, isn't it? At the close of yesterday, it was at 0.33. It was here. It was in the 1 percentile of the total distribution. What is this distribution? These are the values that the put-call volume ratio has hit over time, going back beyond 2007, I think even further than that. We can take a look at that in just a moment. And what it's telling me is if it's down here, very rarely does it ever go lower. It usually wants to swing back up. And how is it going to swing back up? How is it going to go from a put-call volume ratio from 0.4 to 0.5 to 0.6 up to 1? Well, that means that the market is going to have to change. And once this hits, the put call volume ratio is going to have to start reverting back to a 1. And which typically means at that point is because the market's dropped and now it's going to start recovering. But it's strange, isn't it? All these indicators that we're seeing that are bearish, and this one is near the lowest it has ever been. And that 0.33, I don't think I have never seen it that low personally. Oh, the time frame, my apologies. Total time frame here, if we go all the way down the line. Oh, I'm sorry. Yeah, back to 2007, 2008. Okay, all. Yeah, so that would take us back to 2007, 2008 historically, and this is the lowest the put call volume ratio has essentially ever been during that time frame. I mean, you see sometimes it drops here, back in 2012, back in 2011 here, got some other ones. But in any case, it happens once in a while, but it just doesn't stay down there. It reverses. Number of days SPX up, that's bearish. The gap over the SMA 20 historically, that went bearish. Percentage of stocks over their 20-day moving average, that's getting close to bearish. New stock, 52-week high and low, that's bearish. VIX is holding in the middle. That's pretty good. TRIN was actually bullish yesterday. It moved back into neutral. The RSI has gone into bearish mode. And our last one is the MACD gap. The gap of the MACD of SPX broad market indicator has gone bearish. Okay. Now, enough of the distribution, enough of how that works with each individual indicator. What does the sentiment history tell us? 1, 2, 3, 4, 5, 6, right? 1. Oh no, 2, 3, 4, 5. It's only been 5 days that we've hit the sell warning, but back in October, there was another 5 or 6 day gap. 1, 2, 3, 4, 5, 6. Yeah, 6 back there. And that was it. We've been in neutral since then, okay? So the sell warnings are being triggered as what? As we're hitting new highs, as we're extending these gaps, as we're extending the range of these indicators where usually it has to revert back to the norm at some time. And in order for those indicators, when we see them revert back to the norm, what does that mean? That means the market tends to pull back. What I typically look for, by the way, so David, here's the answer. I'm seeing 6 sell warnings in a row a few days ago. There was some easing of the pressure. Think of valves drop down a little bit, not a lot. And it started to move back up, and we started seeing those sell warnings pop up again. It didn't trigger today, thankfully. We're still at a sell warning. Notice down here in the distribution, there's a lower level. There's actually 2 lower levels, but there's a lower level here. Bearish sell, bearish sell, bearish sell. When I start to see these more red indicators hit 1 or 2 in a row, that's when I am taking more definitive action, honestly. Right now, I'm hesitant. What am I doing right now when I'm seeing these sell warnings being triggered? Well, I'm lightening up on my positions a little bit. I did enter that new married put. Think about it. The married put on ESI I just shared. I opened up originally with a 5.6% risk. It started to follow this trend since October 12th, where it was going up. We're seeing these sell warnings. Yesterday, I had an opportunity to roll up the put to bulletproof the position. Ernie sold calls on his married puts in preparation of if there is a decline going forward. That's a good time to be selling calls against stock you own as a potential hedge. It's a good idea to roll up the puts if you have a gain in it to bulletproof the position if you're anticipating a decline, or following the radioactive trading technique, another approach. You saw the 3 positions that I have on roughly in the portfolio for bull put. Oh, sorry, wrong portfolio. November 5th, of the bull puts that expired worthless. So what does that mean? That means that Monday, oh, sorry, folks, Monday, this coming Monday, following this expiration and freeing up the position, the monetary allotment I had in the bull puts for the next cycle, would mean, yes, I'd be opening new positions on Monday. I'm hesitating. I'm going to wait to see what the market looks like on Monday. I might still open positions Monday afternoon, but I'm going to see if there's a pullback a little bit that might start easing off some of these and putting us back into a neutral position. If the market is still extended, like it has been the next 3 days, we go up again as we kind of did today at the beginning, wavered in the middle, and then, so forth. But if this does go into a bearish sell from a sell warning to a bearish sell, I will not be opening new bull puts next week. I would hesitate. Okay. I've already done what I wanted to do with these bearish signals so far. What does that mean? Well, I've added extra hedge to the positions that were already protected, the core holdings of my account, the married put positions. Ally Financial, ESI rolled up and bulletproofed the position. Ernie sold calls on his. I held my bull put credit spreads through expiration today. If I was in a cycle where these didn't expire this week, but they expired next week on November 12th, I might have started closing the positions, some of those positions, easing back on the contract size if I had a 50, maybe 60% gain. If I only had a 20 or 30% gain, I probably wouldn't do it. I'd hold it a little bit longer because I'm still 8, 10% out of the money. Even if there's a slight retracement next week, do I expect it to be 7 to 8%? Maybe only 3 to 4%. But I might not be opening new bullish positions. The question that came in, I apologize, it was not from Kenneth. It was a newer gentleman, Tony, I believe his name was. Tony, a new user of PowerOptions, was asking a similar question. He says, should I shift to bearish spreads right now? Should I go from my main interest is in bull puts and calendar spreads? Should I shift to bearish spreads right now? No. If you're seeing these sell warnings go off and you're in covered call positions, you have bull call debit spreads open, you have bull put credit spreads open, you have diagonal calendar spreads open, cash secured naked put positions. I'm not saying close everything at all. I'm not saying close it all down and go to bearish trades. Not at all. I'm saying add a hedge. Add a hedge to the individual positions. Maybe scale down the contract size on some of the bull put credit spreads or some of your diagonal calendar spreads. Maybe roll down the call in the calendar spread if you're worried about a decline. Or back into the menu here, back into the webinars menu, under the options concepts, consider also looking for a market hedge. Maybe consider buying puts on SPY. Here's one, analyzing hedges on large portfolio exposure. I wanted to look for the specific one, hedging leverage possessions in your portfolio. How to hedge your portfolio with broad market put options. Consider, again, buying puts on SPY, QQQ, maybe even SPX or NDX. I find the ETFs easier to use just for me, in my mind personally, than the higher priced SPX positions and NDX positions, just buying SPY, QQQ. We saw VIX increase today. Not much, but we saw VIX increase today as well as VXX. When the VIX is lower, usually in this $14, $15, $13 range, buying calls on the VIX might be a good market hedge. But that only works with a sudden unexpected event. If you're expecting, and I'm not saying I'm expecting, I'm saying I'm preparing for the unknown with those kind of approaches. Again, protecting the stock holdings, adding hedges to the positions that I have, maybe lightening up on those leverage positions that can cause large losses, such as bull put credit spreads, calendar call spreads, maybe just long call positions, taking some of the profits now and considering a broad market hedge rather than closing everything and shifting immediately into bearish positions. Why? Historically, if there is a bearish position, if there is a bearish adjustment, it's only going to last a short period of time, 1 week, 10 days to 15 days. What we saw from February to March 2020 that lasted 3.5 weeks was a whole different scenario. And yes, in January of 2021, those webinars I showed you that talked about February 5th, 2021, it was going into the bearish signals, big time, pointing us that something down the road is coming up. And the market was going up, 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 but we knew of this pandemic. We knew that things could get out of hand. The market sentiment tool didn't pick that up. What it picked up, David N., is that the market was still extended at that time as it kind of is right now. And there were outside forces. This picked up the decline, it's in a sense, from February 5th to February 9th of 2018. That first discussion of the trade war with China, when the market on February 5th just suddenly snapped and dropped and volatility spiked. The bearish sell warning started going off around January 12th to 15th, and then again on the 20th to the 22nd. I was buying VIX calls at that time because VIX was down to 11. Oh, And it was a perfect hedge for the leverage portion of my portfolio, the 10 or 15% that were in bull put credit spreads and calendar call spreads. That's what that hedge was for. It was for that portion of my portfolio. When I saw those go off, yes, I started selling calls against the married puts as an additional hedge. One of them even did an extra put on to create a synthetic sort of straddle position in case of a downturn. And that worked. Now, I'm going to see how far back I can go, but I don't think I can go too far back on this account. But let's see here. So again, I'm not switching directly to bearish mode. I'm protecting what I have and the leverage portion of my portfolio. Here you see it here. December 21st, 2018. Why am I seeing buys in this situation? Well, it's not letting me. Let me go to details here and see if I can go back any further than 11.5. Back in September, there were sell warnings again, and I was pretty sure one of these was a bearish sell. I think I might have changed my criteria, but in any case, what was this leading up to? Remember the start of that disastrous October in 2018? Then the market started to recover, and then it fell completely. 2018, 6 out of 12 months were negative. And those last 2 months, October and then the crush in December, were devastating. That's why this started to go into screaming buys. And it did recover in November and go back to neutral. But when it started coming back up to neutral, it just fell down hard. It went back into sell warnings again. Then it fell in December. And December started giving those very strong buy warnings. And do you remember what happened in January 2019? Effectively lower left to upper right. Let's just take a look here. I'll go chart, big charts. And let me do a custom. Oh, that's not what I wanted. And we're going to go February. Let's go January 1/21, 2018. And let's go to 1/30, 2019, okay? All right. Okay, so as a view, started to see those strong bearish sell warnings back here in January. And what happened? This is February 5th through 9th, 2018. This is that decline of March to April 5th, I believe, March 21st to April 5th. A little other hiccup here in July. This is the October. This is those sell warnings that started to appear in September. This was October. November started to recover. And this was the December. Sell warning started to trigger again right about here. It went to neutral in October, but then it clear came back in November. Then it started screaming bearish sell, and that was the end. Now you're seeing all these strong buys because it went right back up to here in that first month of January 2019. Okay. Did I go bearish at these points? No, I hedged the long positions that I was in. Even though I had married puts on them, I added extra hedge to the position. I lightened up on my bull put credit spreads. Although we could say that from here, this was a tricky time, by the way, from about September 20th here to December 26th, was it? The day after Christmas, I think it was. Yeah, it was right around December 26th. That's a huge decline from 2,900 or 290 in SPY down to about 230 almost. That was a huge decline. It's about a 30% decline. But it wasn't straight. You had what? We had, not just you, we had, this was about 2.5 weeks of a decline. This is a pretty big move. If you were in bearish positions here in that first week of November, you would have gotten taken out. Then you had about another 10 to 12 days, a fortnight, let's call it. Maybe here would be a full 3 weeks in decline again. And then what? You're still in bearish positions. You're getting slaughtered here. You're getting slaughtered here, made great here, and then got slaughtered here. I could say the same thing. If I'm in bullish positions, would have lost here, made some back, lost here, made some back, and then here. This might have actually, despite the prices, would have been a great time for a straddle or a strangle position, buying a call and put, not selling, buying a call and put either right at the money or out of the money if you got into it over here. At this point, you're just getting whipsawed with any kind of credit spreads you're doing, covered call position, cash secured naked puts, you're bouncing around all over the place. And so when you see the sell warnings, lighten up, get extra hedges on your stock positions, buy the puts, maybe create some collars on those positions. Don't necessarily open new positions that are leverage bullish. Don't necessarily get into any long calls, any bull put credit spreads, maybe not even any bull call debits. But when the easing valve goes, 2 to 3 week period, could I trade bears right here? Yes. But if I don't get the profit quickly, I lose it all. If I don't get the profit quickly, I give it all back. If I don't get the profit here and catch it right away, here you're still probably good with the profits. Here you gave it all back. Okay, that's the trick with playing the bearish side. That's the trick of trying to catch the bearish move. It's not a bad idea to have bullish and bearish in your portfolio, David N, at all. It's not that bad of an idea. But the trick with playing the bearish moves, and I know this is just 1 year, but is you got to catch the profit quick, because usually a week or two after those profits hit, you're almost giving 50 to 60% of it back. You've got to be quick if you switch to bearish. That's why I typically don't do it. If I'm more bearish on the market long term, that's a different story. That's not what the market sentiment indicator is really showing us, though. What it's showing us is that these broad-based indicators are pointing to an overbought, a range that they don't necessarily normally hit, especially the put-call volume ratio. Eventually, you expect them to go back into the neutral range. What's going to cause these ones to go back into the neutral range? A releasing of the valves, a pullback, a decline in the market. Now, I'm not talking about 10, 15%. I'm not saying a 20% correction. I'm saying that this is going to be potentially, what have we seen? Let me go back to that. What have we just seen here in the last year, let's just go a year and a half. We have this melting up and this correction. Let me see. Yeah, there we go. Need to clean this up a little bit somehow. Can I take out this? Yes, great. I can't take that out. Okay, let me draw the chart again. Okay, sorry about that. That's perfect. When I showed you those other archived webinars on the market sentiment tool where it talked about February 5th and it talked about April of 2021, why was that important? Because we were seeing events like this. Get a pink one. Something brighter. We're seeing signals such as this, and then we started to hit a peak here up near April. It went to a bearish sell, and we were here. Okay, and then up here we're seeing another peak. Started to see some sell warnings, and we had a little hiccup here. And then in February, up here we were seeing sell warnings, and that kind of led to this. End of January, January 2021, we were starting to see the sell warnings and a bearish sell, and that sort of led to this event. It was kind of indicating that this event was coming. These aren't huge drops. What are we in? We're in a melt up. We melt up, have a little glitch. Melt up, have a little glitch. Melt up, have a little glitch. Okay, so not all of us would say these little. Some of us got hurt pretty bad on these glitches, I understand. I'm not trying to make light of that. But that's what we're sort of doing in this recent melt up. And then here's 2 Septembers in a row, down about 8% this year, 2021, 8.4%, I think, the month of September. That 2.5, 3 week period was the decline period, and then it recovered. But in 2020, it was 10%. But again, it was only over a 2.5, 3 week period where that decline happened from September 3rd to about the 24th. And then we just go right back up. So you can see, just looking at this chart, if we just go back to, but I'm just showing you this, David, this is what we've been seeing here. And yes, we have these little blips. And just like I showed you in the webinars, the archive webinars, why did we talk about this in January? Oh, because the sell warnings were going off. We had an indication. Why are we talking about this in March? Oh, that was a terrible drawing. In April, around March, because the sell warnings were going off again. And then there's where we hit. Okay, in April, we saw another little one. And we had that webinar on the market sentiment in April. And every time these start to hit, was it August was the other one? There was that. So right in July, started to hit the sell warnings again. And we have a little pullback. So am I expecting this to go here again? No. I'm preparing for it lightly in case it happens. I'm hesitating until I see an easing on these, on opening a lot new of those leverage positions, diagonal spreads, bull put credit spreads, which can result in 50, 60, 70% losses. But I'm not going to bear either, because if there's just a little ease and then we keep doing this, that's not going to help me. That's not a projection. I'm not saying that's what's going to happen. I'm saying that that's been the trend that it's been going. And we've seen these little blips with the sell warnings. And it's always a good idea to prepare and to have a hedge in place, whether it's an overall portfolio hedge with broad-based put options, VIX calls, or other events, hedging your positions individually, lightening back on some of the contracts you might have on leverage spread positions, leverage long calls if you're overexposed, take some of the profits on some of those, ease them back a little bit, and then if we have a light correction, switch back to neutral, jump back in. But you don't want to give up too much of your profits that you've earned. Could we see that drastic decline? I'd expect to see one or two of those strong bearish sell warnings pop up if that was the case for a more pronounced downtrend. It could be a light move and then ease back up again. That would put us back into neutral. That would ease the valves off the sell warnings. If we start to see bearish sells, it could be 2.5, 3 weeks of another 8 to 10% decline as we saw in September. It could be that, or September of 2021. That is possible. But again, I'm not seeing strong sell warnings yet. I'm lightening up, protecting the positions. If you have covered calls that you're worried about, you want to add an extra hedge sheet, you might consider rolling down the calls. That's maybe a little bit too preemptive, because if we have a little drop of 1% on Monday and then another drop of 0.5% on Tuesday, this will likely go back to neutral. That will be enough easing of the pressure on these 13 valves to move back into that range where the put call volume ratio might still be bearish, but these other ones shifted back to neutral. It's not a buy recommendation yet, but it would go back to neutral. That's when I'd start opening bull put credit spreads again, feel a little bit more comfortable after the easing off of these bearish pressures. Okay. So again, there's some of those other discussions there in the free webinars. On the fly, David, I hope this did help you out. David says, thank you, very helpful. That's great. That's how I use this, and this is how Ernie uses this as well. Ernie uses it much more as a buy indicator. He likes to go a big in when he starts seeing those light buy and those buy recommendations. I do lighten up my positions. I'm going to tell you again, honestly, I'm not opening new bull puts necessarily on Monday until I see what happens on Monday. I would normally be looking to open positions Monday afternoon. I'm hesitating right now. No, I'm not going to see the market sentiment change till November 6th, but how the market performs on Monday is going to tell me, do I need to hesitate one more, because this might be going to a bearish sell if those were still moving up and those indicators are still going in that direction, and we shift to a 7 sell and 6 neutral and no bullish. That might trigger into the bearish sell. It might be 8 actually, 8 and 6. I'm sorry, 8 and 6, 8 and 5 in that case, but we'll see. So I'm hesitating on new positions right now. Doesn't mean you have to. You might have a completely different market outlook, but that's how I use this tool. Lighten up on some of those positions. Thankfully, I had the opportunity to use income method number 4 on that new Mary put, so I'm bulletproof now while these sell warnings are going off in that case. Sal says he uses the 9 versus 18 EMA crossover, which picked up the February 20 crash and March 20 rebound. Fantastic. So he's using the 9 versus 18 EMA. That's not one of the broad-based indicators here, but it's something that I might consider telling Ernie to look at, or I will look at myself, Sal, honestly. But again, not just for my stocks, but for the market as a whole. Maybe I'll ask Ernie to take a look at that. I've got it down here in my notes, Sal, 9 versus 18 EMA.